Hello everyone. In this video I'm going to continue my discussion about accounting for merchandising businesses. And where we stopped was when we recorded purchases. In this slide we're going to see the purchases discounts. And most businesses, whenever they're offered a discount, they should take advantage of it, and we'll see why. So to encourage the buyer to pay before the end of the credit period, the seller may offer a discount. Of course, it's not always in all cases, but in many cases whenever the seller wants to get the cash quicker, they offer this kind of discount. So let's see this example. A seller may offer a 2% discount if the buyer pay within 10 days of the invoice date. If the buyer does not take the discount, the total invoice amount is due within 30 days. And this is the term that we had in the invoice in the other video, where we've seen the 2/10, comma, net n/30, which is pronounced as or read as 2/10 net 30. So 2% discount if paid within 10 days, the net amount due within 30 days. So the seller in this case is offering 2% discount if the buyer pays their balance within the first 10 days, and then the entire balance has to be paid within 30 days. So let's see this like on a calendar and how this would work. So let's assume that the invoice date or the transaction date was January 5th. So in this case, the amount has to be paid within 30 days is February 4th. You can take advantage of the discount by paying on the 15th, and that would be within the first 10 days. So you see here, this is what we call the discount period, which is you pay in any days between the 5th and the 15th. And in this case, the amount due, if paid on or before January 15th, would be $2,940. And how did we get that? It's 3,000 minus 3,000 multiplied by 2%. Another way to do this is just get 3,000 multiplied by 98%. And how did I get the 98%? It's the 100% minus the 2%. So again, it would lead to the same answer. The credit period is 30 days, and it says here 30 days consisting of 26 days from 31 to the 5th day in January and 4 days in February, in the months of February. But if you paid in any of those light green days, you'll have to pay the full amount. So you might think, oh, the discount is only $60. Is it really worth to pay like 20 days sooner to save $60? And the answer is yes. $60 for 20 days is compared to the $3,000. That's relatively a large percentage. So discounts taken by the buyer for early payments of an invoice are called purchase discounts. Purchase discounts or purchases discounts taken by a buyer reduce the cost of the merchandise purchased. And we always assume that every single buyer should take advantage of these discounts if offered. So assume that Net Solutions places an order from Alpha Technologies on January 5th with the terms of 210 net 30. In order to pay the invoice on January 15th, which is within the first 10 days, or in other words, that's the last day of the discount period, Net Solutions decided to borrow the amount that should be paid, which is $29.40, which is the $3,000 less the discount of $60. If an annual interest rate of 6% in a 360-day year is assumed, then the interest on the loan of $2,940 or $2,940 for the remaining 20 days of the credit period is $9.80. And how did we calculate that? It's $2,940 multiplied by 6% multiplied by 20 days over 360, assuming the year 360 days. So is paying an interest of $9.80 versus getting a benefit of $60, you do the math. I think it's obvious that if I can borrow at 6%, in this case, it's feasible for me to pay within the first 10 days. So let's see the net savings in this case. So the net savings to Net Solutions of taking the discount is computed as follows. The discount of 2% on the $3,000 is $60. The amount of interest for the 20 days at a rate of 6% on the $29.40 that we borrowed is $9.80. So the savings from taking this discount is $50.20. So if Net Solutions does not take the discount, it pays an estimated interest rate of 36% for using the $29.40 for the remaining 20 days of the credit period. And how did we do that? We just take the 2%. Remember, it was only for 20 days, so we convert it to the entire year by multiplying it by 360 and dividing it by 20. And that would be 2% multiplied by 18%. In this case, it's going to be 36%. So if you don't take advantage of this little 2%, in reality, you're not taking advantage of 36% per year. And assume that you keep taking discounts for every single purchase transaction that you do. At the end of the year, you're saving 36%, assuming that it's always 2% within the first 10 days. So again, this tells us that it's really important that we take advantage of these kind of discounts, to the point that we always assume that the transaction would be at the discounted price. So since buyers normally take all purchase discounts, inventory is debited for the net purchase price under the perpetual inventory system. That is, the buyer debits inventory for the amount of the invoice less the discount. So let's see the journal entry for that. So Net Solution would record the Alpha Technologies invoice and its payment as follows. We see that they're debiting inventory and credited accounts payable for $29.40, even though the invoice is for $3,000. Why did we do that? Because we assume that we're going to take advantage of the discount. So by the date we make the payment, which is within the 10 days, in this case here it's January 15th, we debit the accounts payable and we credit cash. So just to remind you why we debited inventory and credited accounts payable. Inventory is an asset, and we bought assets, so the assets are going up. And assets, when they go up, they like the debit side. Accounts payable is a liability, and it's also increasing. And liabilities, they increase on the credit side. When we're paying off our debt or our accounts payable, we reduce the liability, and when we reduce the liability, we credit the accounts payable. And then we also paid cash, so we're reducing the amount of cash, which is an asset, so that's why cash is on the credit side. And again, the main thing here is that we didn't use the $3,000, we used the $29.40, which is the discounted value. Now let's talk about purchase returns and allowances. In many cases, we buy an item and then we decide to return it because it's different from the specifications. There's something missing, there's something broken, damaged, defective. So in this case, we might return it to the seller. So a buyer may request an allowance for merchandise that is returned. We call that purchases returns. Or a price allowance, and in this case we call it purchases allowances, for damaged or defective merchandise. From a buyer's perspective, such returns and allowances are called purchase returns and allowances. So in both cases, the buyer normally sends the seller what we call it a debit memorandum or simply a debit memo to notify the seller of the reasons for the return. In other words, the purchase returns, or to request a price reduction, which we call it the purchase allowance. So why we call it debit memo? Keep in mind, whenever we are buying something from a supplier or from a vendor, we record on our side accounts payable. The accounts payable would be recorded on the credit side. When we pay it off, we just debit the accounts payable. So what if we return it? We are also going to debit the accounts payable. And the debit memo got its name because we are debiting the accounts payable. So in this case, we're telling the seller, or in this case the vendor or the supplier, that we're debiting your accounts payable on our side. Why? Because we're returning these kind of items. So debit memo also informs the seller of the amount the buyer proposes to debit to the account payable due to the seller and states the reason for the return or the request for the price allowance. So let's see how a debit memo would look like. So here we have our company, Net Solutions, and here's our address, and we have the debit memo to Maxim Systems, and this is their address, and this is a different company, and we have here the date we're returning something, and we debited your account as follows. And you can see that we have a description, the unit price, and the total value that we're proposing to debit. The buyer may use the debit memo as a basis for recording the return or allowance or wait for approval from the seller. or in this case, the creditor. In either cases, the buyer debits accounts payable and credits inventory. So remember, the debit memo is referred or got its name because we are referring to the accounts payable in this case. So Net Solutions records the return of the inventory indicated in the debit memo on the previous slide as follows. And by the way, this is not a right slide number. We need to correct that. So accounts payable would be 900 and inventory would be 900. So we basically reverse what we've done when we purchase inventory. So instead of having inventory on the debit side and accounts payable on the credit side, we debit the accounts payable because we're reducing the liability, so it goes on the debit. And we also reduce the asset, which is inventory, so we credit inventory on by $900. So before paying an invoice, a buyer may return inventory or be granted price allowance for invoice with a purchase discount. In this case, the amount of the return is recorded as its invoice amount less the discount. So don't forget about the discount. So let's see. Assume the following data concerning purchase of inventory by Net Solutions on May 2nd. So we have here 3 transactions, and we'll see how they're going to be recorded and what are the journal entries related to these. So May 2nd purchased $5,000 of inventory on account from Delta Data Link. The terms are 210 net 30. By the way, we kept using 210 net 30. Could be different things. It could be 320 net 40 or whatever. But the main thing here is that I want you to get the concept that 2 is the 2%, 10 is the 10 days that we're going to receive the discount if we paid within these days. And then the N stands for net, and 30 is the maximum amount of time we can pay our balance. So in this case, since we purchase inventory on account, we're going to assume that we are taking the discount, which is 2% of the $5,000. It's $100. So we deduct $100 from the 5,000, and that would be $49. So we debit inventory, and we credit accounts payable for Delta Data Link, and it's $4,900. So you can see here that we assume that we're taking the discount. So 5,000 minus 5,000 multiplied by 2%. Then we return the $1,000 of inventory purchase on May 2nd. Keep in mind that we're returning $1,000 value, but we actually have a 2% discount. So we also need to take 2% of the $1,000 to reduce the amount of inventory and accounts payable. So you can see here, this is the opposite of what we had on May 2nd. On May 4th, we debit accounts payable and credit inventory. But not for the $1,000, it's $1,000 minus the $20, and that would make it $980. On May 12th, which is the last day in the first 10 days, we paid the purchase of May 2nd less the return and discount. So we're going to pay the $4,900 minus the $980, and that's $3,920. So we debit the accounts payable because we're reducing the liability, and then we credit cash because we're actually paying cash, and cash when it's paid, it's recorded on the credit side for the $4,900 minus the $980. Okay, so let me stop here, and the next video I'm going to be talking about the sales transaction and how we look at it from the seller's perspective.